Welcome to TradersPost office hours for February 23rd, 2024. I'm Tom Hartman, part of the marketing for the TradersPost team, here with the ever insightful Mike Christensen, co-founder. Hi, Mike. How's it going?
Good, Tom. How are you doing today?
Pretty fantastic. I'm shorting Bitcoin, so look, if Bitcoin's going down, I'll be happy. That's always how it is.
Glad to hear you're on the correct side of that.
Yeah, well, it's pretty interesting. I mean, we'll go over it over other videos, but I've been trying out the hedging strategy instead of my normal one of just putting money in and then losing. So this one works a lot better than that.
Yeah, I'm not a fan of the losing strategy.
Yeah, what is very interesting, this idea of the stop loss. You almost want the stop loss as an opportunity to hedge and make a little bit more money on the other side. So it's been working pretty well so far.
Okay, good to hear.
Excellent. So as usual, we go over your questions that you've submitted in support tickets, online, Discord, what have you, in order to make your experience with TradersPost that much better, that much easier, and that much more fruitful. We want to make TradersPost the best automated trading software for you, and for that, we need your feedback. So thank you very much for posting your questions. Let us go over some of the questions we have for this week. I had some good responses for last week, but I think these questions this week might be even more fun. The first one I want to be tackling, look, this is going to be, let's not, we're very happy to be using TradingView, very happy with the platform. But the specific question I saw in the support forum was that on TradingView, you can connect your broker to trade manually. And so why can't we automate trades directly on the platform using PineScript or anything like that?
Right.
Now, yeah, if you want to take that away, Mike.
Yeah, sure. We've actually spoken with the product team at TradingView, and as far as we know, there is no plan for them to offer automation of any kind. Now, that may have changed, but at least as of the last conversation we had with them, their roadmap is really focused on the charting side. Broker integrations occur really with the brokers themselves. They actually have to do the development in order to be added to the TradingView platform. So, the opportunity there is really to help execute trades through those brokers in a manual effort. Now we can talk about it from can I set an alert and trade that particular alert? I haven't seen that as far as I know. I think you have to basically just route the order to the broker through TradingView, but there is no current way to take a trading strategy or indicator and essentially send that signal to the broker in order to trade those trades in live mode. And like I mentioned earlier, TradingView doesn't plan on supporting this at all. So obviously, as you might imagine, that's what really kind of created the opportunity for TradersPost to begin as a business, was that this was an open opportunity for us to support the ability that TradingView provided for you to send alerts via webhooks. But that same opportunity exists on many platforms, not just TradingView. We support MT5, we support TrendSpider, we support custom code like in Python or in JavaScript. So any environment where you're able to send off the signal for the buy and sell order, we can support that. TradingView is just one of many areas where that can be done. But to the original question, there just is no way that you can automate directly on TradingView through the broker integrations that they have. You're able to see your P&L. You're able to, see your open orders. You can see your orders on the chart. I use that every day for sure with TradeStation and Tradovate. The integrations that they have there are great for manual discretionary trading. But from an automation standpoint, there's just no way to do it. Except through
that makes sense to me. Well, exactly. Well, when I think about it, what I want is for TradingView to, and I'll just mention it here because I spend my Saturdays sometimes trolling Reddit, answering people online, and this question comes up all the time. And you think to yourself, do you really want TradingView to be spending its time with the nuts and bolts trying to make sure that it can integrate with all these different brokers, all these different platforms, and troubleshoot there? Or do you want them to make the best charting software you can have? Right? People have... I think to myself, I want new indicators. I want new drawing features. That's what I want on the platform. And I'm so glad that they're not actually trying to be the one-stop shop for everything, because there's no way they're going to be able to account for all the different use cases. And then it would just slowly atrophy over time. So I'm perfectly happy that they're trying to, that they've basically created, or they're counting on a third-party solution, and it creates a whole industry for us, so that they're not taking everything, all the chips on their side of the table. They're leaving stuff for the rest of us. So that's great.
Right. Agreed there. Our CEO John has been lurking in our live channels recently, and often comments. So appreciate when John does this. But he did point out that some customers are plotting lines on their chart and setting alerts with those lines. And with those alerts, you can create an order. You can effectively connect the line to an order with the broker. But other than manually placing lines on chart, it's not really very, very common. Then another question that we might add to the list here, Tom, is when somebody asked if we'd be able to explain the OAuth flow on this office hours today, essentially how that works and why we choose to do that with the brokers. So happy to cover that topic as well.
Yeah, well, let's touch on that now. So this is about authenticating connections to a broker. Is that it?
Yeah, I think that's the question here. So with the OAuth flow, essentially OAuth in general is a new open format for authenticating users on another platform without the need of sharing your username or password. So it's a much more secure way of actually logging into systems because there's no more passwords floating around. The method that we use with many brokers, not all brokers, but like Coinbase, for example, we use an API key. With many of the brokers, TradeStation, TD Ameritrade, there's an OAuth flow there where when you click connect a live broker, you're going to log into your actual account with the broker and then authorize access for TradersPost to access your broker account. Once that OAuth token has been issued to us, we have to then follow the rules for how those tokens need to be used. We essentially are given a temporary pass to your account that allows us to trade on your behalf, execute orders, get back, information about your balances, things like that. But then we have to keep asking for permission over and over again. And this is through a process called refreshing, or token refreshing. If you ever decide that you don't want TradersPost to access your broker account anymore, you can just delete that token in your account, or delete the authorization on TradersPost, and then you don't have to worry about changing your password or anything like that. So it keeps your account super secure. It makes it really easy for us to access your account without storing any passwords on our side. And maybe that last point is the biggest point of all of this. If we had to store people's usernames and passwords in our database, and we were ever compromised as a business, that would be pretty painful for everyone to have all their usernames and passwords to their broker accounts suddenly exposed to some other, bad actor. So for us to use OAuth, not only is it a secure way for us to access your account, but it also means that your passwords aren't floating around the internet somewhere.
I thought it was pretty interesting the way that this question came up, or the last time I saw it, where the person was like, well, how did you even connect? Like, I didn't provide you with any of this information. Like, I'm pretty concerned. And I love that the answer was that no, we are, if there's anyone who's security conscious, it's us, and so we want to make sure that we're doing that properly, and that we're using this OAuth voodoo in order to get into your account. And the person's like, oh, okay, yeah, okay, perfect, that's fantastic. So just to rest assured everybody, we're you don't build a business like TradersPost by having loosey-goosey things that's just hanging around. We want to make sure that when you're using the platform, it's as secure as it can be.
And on that topic, we kind of cover this in a few paragraphs on our website. If you head to the footer of traderspost.io, you'll see there's a security button there. And we have a couple of blurbs that explain how our process works, how we secure everything. And of course, if you have any questions about how we manage that security, feel free to reach out to us as well.
Excellent. So another question that showed up recently was this question of relative position sizing. So if you're setting the position size from TradersPost and you're using a relative position size, if you don't have enough cash inside of your account, does the trade open up to the amount of cash that you have, or is it skipped altogether?
So let's say that I chose like 5% of my account balance as a relative position size for for like just stock trading, for example, just to keep it simple. Um, each time that a 5% position is opened and I use some percentage of my account, we of course are constantly monitoring the net asset value of your account. So whatever your, it's not really just like the cash available in your account. We're really looking at the net asset value. So the equity value, if you will. When that last 5% is requested, if we ask for too much, when we send that signal to your broker, the broker then decides if you have enough cash available for that trade. So they're likely going to reject it. And the reason that we do this, if like we ask for too much and just wait for the broker to decide if you have enough, is because we don't know, we may not know if you have a margin agreement with them or not, where they'll allow you to trade on margin and let you take a little bit more. Um, and we're not currently tracking cash in a way that allows us to perfectly decide how much cash you have available and what you can use. There are some scenarios in which you might ask for that final 5%, but you only have 2% available cash. We do want to maybe make an improvement there where we just end up using your 2% instead of rejecting the trade entirely. But we're looking into a solution there. So in general, it's kind of up to the broker. In terms of how they respond with that final percentage of cash in your account.
Great to know. Actually, I might write something up for the documentation. Just put it there because I don't know the question comes up again and again, but I thought it was pretty interesting and pretty legitimate question.
Yeah, for sure.
All right. A casual question here for you, Mike, because I'm very curious. You're a busy guy, and so I find that when you're captured here in office hours, it's my opportunity to grill you with questions.
Oh, great.
I'm curious about what you watch inside of the retail trading space, or even just markets in general, and more specifically, if you've seen anything over the last week or two that you found particularly interesting, you'd like to share.
Uh,
I'll start off if you want while I think about that.
Yeah, for sure. I know you have some insights there as well. I definitely have some ideas. I'm trying to decide how much I want to share.
Sure. Well, I'll just bring up one of the. I saw an interview recently with Daniel DiMartino Booth and Jim Bianco from Bianco Research.
Mhm.
I don't know if you know these people. Danielle DiMartino Booth used to work at the Fed, so she's very vocal about it. She wants the Fed to end. So okay, I'm going to follow someone like that. I'm going to see what they have to say. And Jim Bianco was considered, I think, for a Fed. As a Fed board member, if I'm not mistaken, and
Mm.
so it's interesting. And there was something. Jim has been very pro Bitcoin and very pro crypto. And then he was talking. Someone asked him about the ETF, the new ETF that was that was approved for Bitcoin, and what he felt about that. And this guy launched into a tirade about how he thought it was a terrible idea, and that basically crypto's giving up or Bitcoin's giving up the dream to the BlackRocks and the Vanguards of the world. And I was
Mm.
sort of like taken aback. I was like, I wasn't prepared for that. I thought it was going to be Bitcoin all the way. This is a great thing, great for the ETF. And so if anyone I love the debate whether crypto was good or bad. Whether it's a a Ponzi scheme or the vision for the future or whatever it is, and that interview was I thought was pretty. That answer was pretty spectacular to me. I was not expecting it.
Yeah, I think that's pretty good insight too as to what the real objective of cryptocurrencies is. I think exposing an ETF really just reinforces this idea that crypto is a speculative asset that really is driven by speculation and greed. And I think that does show up in the marketplace. Ultimately, a lot of volume that shows up is driven by speculation and the desire to catch that next to the moon coin, right? So the idea of an ETF gives more of that speculative exposure to a much broader retail audience. And I can kind of see his point. It sort of betrays the original intent of what crypto was supposed to represent. Now we're seeing it fall back onto the traditional finance rails. It's making its way back into the homes of Americans in sort of the wrong way, or a global audience now. It was supposed to free us from a lot of those restrictions, and I get all of that argument. At the same time, it's still tough to see how crypto has seen the adoption curve we were all hoping for. We're since 2009 now. We're well into an adoption curve that should have taken place, but there's still so many people that have never purchased or used Bitcoin or any cryptocurrency, I think, for its intended purposes. So there's a lot to feel and to watch about the retail environment for crypto, but I still think at its core right now, it's a speculative asset.
Right.
Maybe to the question, I know I kind of like attached to some of the stuff you were watching there. On the retail side, some of the stuff that I like to watch that I think is particularly informative is everything that's really kind of broadcast on YouTube and Twitter. I like to see what indicators people are using, new approaches to markets, what they're willing to publish. There's a lot that I know people aren't willing to publish and share, which totally makes sense. But it's fascinating to me how creative people can get with indicators that, in many cases, many of these indicators overlap in terms of their signal. And so, you might feel like you have a brand new viewpoint on how to measure something, but the vast majority of indicators out there are all derivatives of price, and price is the last, pretty much the first and last thing we should be paying attention to. So I do pay a lot of attention to what's popular at the moment. Like, if there's waves of interest on MACD style indicators or RSI based indicators, or, new types of channels, things like that. I think that's all really fascinating, just to see how the market perceives its ability to measure the market.
That reminds me, yeah, it's great. It's great to have somebody who has that sort of mindset to deal with day by day. I'm looking for a community. Like, I think TradesPost could be a nice community. I like the Discord server where people are looking to trade ideas and what works, what doesn't work, and how to fix things. But to share content like this, maybe it's something we might think to. Who knows? Maybe we'll share a little bit on the TradesPost Twitter account. Anything that we find might be particularly useful to retail traders. We'll see.
Yeah,
We'll see.
for sure. Okay. I like where your head's at, Tom.
All right. So let's get back to some of the questions that we had from the support.
Okay.
Specifically, this one is, this has come up for a little while now, and it's about TD Ameritrade. So for those who don't know, TD Ameritrade and Charles Schwab, Charles Schwab, I believe, has purchased TD Ameritrade, and so there's going to be this transition between from users from one platform to the next, and this has some effect on the API, on integration with TradersPost. Do we have any idea specifically when users can expect that cutoff to happen, where they might have to switch the way that their integration works on TradersPost, or is that still up in the air a little bit?
It's user contingent. So if you do a search in your inbox with Schwab or from TD Ameritrade, you should be getting regular email updates from them about the status of your account. Essentially, from what we can tell, they have separated users into different cohorts and are starting to roll over those cohorts to either just full Schwab support or still having legacy access to the TD Ameritrade API. So in order to answer the question about when TD will stop working for you in your TradersPost account, you'll just have to refer to your email from Schwab or reach out to their support to see when that cutoff date is for your account. The dilemma we're in right now with Schwab is that they haven't released publicly their API for us to connect to and essentially support Schwab as a broker. The moment that becomes available, we'll scramble to do the integration there, cross our fingers that it's very similar to the way TD works. If it's a completely different API altogether, it's going to take us a little bit of time to integrate and test and make sure everything's working perfectly before we open it up to customers. But it would have been great if the Schwab API was available before this transition took place, but we're having to play a game of catch up here. As soon as that API is available, then we can make it available in customer accounts so that there's no potential for outage.
I'm sure they're following a minimal viable product sort of idea. Just announce the merger, announce the new systems, see how many people want to connect, and then build the API afterwards. I think that's the way to, to go about it.
I think it's going to keep lots of customers happy. Yeah.
Right. So, all right. So in general, it's great to see, and I mentioned in the Discord and the because it is a place where a lot of TradersPost users come,
Mhm.
especially people who want to start using the platform. They want to know if it's good for them, and I wanted to, and so some of the problems that show up are usually very granular. They're very specific to a specific use case and stuff like that. And this is one of the next question is along the same lines where someone was sending um, trade signals, very close together, and this back-to-back trade signals was causing a problem with their trade execution, with what they expect to happen.
Mhm.
Would you mind going over maybe one or two types of dangers that would show up if someone tries to send signals too close together?
Yeah. So I think the biggest problem with sending trade signals together is something in the engineering world we call race conditions. And race conditions are basically like when two things happen. You might send two things together so quickly that it's difficult to tell that they have an in order relationship. The way and so what ends up happening is you expected the first one to trigger first, but instead what had happened is the second one triggered first. And the reason that happens is because of the nature of how TradersPost systems work. Every time you send signals to us, it ends up in something called a message queue, and that message queue isn't in a first in first out order. It can often be processed in parallel so that we can process as many trades as possible. If we have as many customers as we have all sending in orders at the same time, we need to be able to execute them as fast as possible. If we followed a first in first out approach, it would mean that a bunch of people were delayed because they weren't first in line. So we want to execute them with the broker as fast as possible. We want to get them off to the broker as fast as possible. So this concept of sending alerts back to back or really fast in sequence, multiple times a second, can lead to this problem where we might execute your sell before we try to execute your buy, and put you in the wrong direction, or possibly just not execute the trade the way you expected. So it's another reason that we don't really advise trying to do really fast-paced scalping strategies, because of the delay of those executions, but also because the order of those events isn't necessarily guaranteed. So we recommend trying to space out your events a couple seconds apart at least, so that there's time for the message queue to execute your order properly before the next alert comes through.
That's great. As a lifelong programmer, we're always thinking about things in terms of this domino effect and what's there before, and we build this Rube Goldberg system in our minds, and sometimes it can be a little bit. Sometimes I could be a little bit taken aback when someone asks a question. I go, "Well, of course, because this setup is not there beforehand, and so the system doesn't know, what happens. It can make the prediction. It can make the next step accordingly. But if you don't have any programming background, I can understand how it could be a little bit confusing. Just know that it's the same question that sort of touched on what we talked about last week, this high frequency trading, where people want to send multiple orders right away. They have the strategy, the performance looks great, and then they execute it, and then they're not thinking about slippage, not thinking about the time it takes for the order to go through and all that. And so all these things need to be taken care of. Trust me, if anyone can get your order execution or any command to execute within 1 millisecond, that's what they're going to do. Like, if it was possible to go faster, make it optimize it that much more so that you can actually get faster and faster trade times, and or be able to send back-to-back trades or what have you, we would do that. But there are technical limitations. There's gravity, there's light, there's the electromagnetic field. There's nothing we can do about that. And so let's work with what we have in order to make and build our strategies accordingly.
Yeah. I
Um,
mean,
Mike,
if we're comparing what is possible versus what we can support, those are two different realms entirely. Certainly, what's possible is millisecond based orders, but you've got to be at near the exchange. You have a fiber optic connection there. You're not using TradingView. I know that much. Your strategy is written on actual cards at the machine level, and you're executing trades extremely fast that way. But in this realm, we're running more of a 400-meter dash versus a 100-meter dash. We're well behind the institutions.
I just got this flash of some guy sitting with a laptop, like in Die Hard 4, at the servers inside of the Nasdaq, trying to beat the the hedge funds. That could be me. That could be me this weekend if I can drive down. All right. I want to ask. Okay, so I got a last question here for you before we wrap this all up. And actually, before I do that, let me just put this out there for anyone watching. If we've been putting out videos recently for how to integrate with how to use different indicators to develop strategies around that, and we would love to get feedback from you either on those videos or anywhere you like to get in touch with us to find out if there's any indicators that you particularly use that you would like to find out. Hey, is there a way for me to convert this into a type of strategy? Maybe you have a strategy in mind. Maybe there's maybe it's missing some features that you think if it had it, then you'd be able to turn it into a proper strategy. Maybe you've been trying to turn one into a strategy, but it's not working, and maybe it might be useful to have a video that goes over why certain indicators might work in an automated strategy and some that don't. So if there's anything like that, please feel free to leave a message in the comments on Discord, send a message, and we can't promise to get to all. Heck, we can't promise to get to any, but we do want to hear what your feedback is, because if there's any way we can be helpful in that way, we'd love to be. So just let us know.
On that subject, Tom, we did get a comment on YouTube recently asking for a tutorial on how to do this with SuperTrend, which I know is one of the bigger, more popular indicators on TradingView. And we had a video that we published a little over a year ago that got quite a bit of views that showed like that you could automate a strategy on TradingView, but it didn't really cover exactly how to do it with that SuperTrend strategy. So that could be one we revisit.
Perfect. Yeah, and I also gonna have put on my list the Lorentzian classification from Jay Doherty. I don't know if we've done a video. We have a video where you've talked to him, but I don't know if we have a video about turning that into an automated strategy. It might be pretty interesting to take a look at.
Yeah, I think we need to revisit that one too. In that conversation with Justin, we kind of covered that it's a little bit difficult to backtest because of the nature of how his looping mechanism works in order to do the classification. You can't really run like extensive back tests on it. So we'll have to cover the complexity of that one. It's written a little differently than a lot of other indicators.
Okay, fair enough. Perfect. So then my last question, something casual here, and I'll start off with this: about what advice would you give to a beginner trader? I mean, there's all the common stuff that we know. Don't bet more than you're willing to lose. I still haven't learned that lesson. I know it by heart. I know that's what you're supposed to say. But if I was going to give any advice to any trader at all, something that I would want to know when I first started, it's this idea that what you're monetizing in the markets is your knowledge. It's why I like markets. You're monetizing. You're able to monetize your own knowledge, how to generate an edge. And so it's any cycle that you can understand, you could possibly get an edge in if you understand the idea of when earnings come out, if you have understanding of how CPI affects the market, if you have an understanding about liquidity flows or whatever it is, you can find some edge or some way of surfing that wave in order to make money for yourself. But any cycle, any systems you don't understand that you participate in, you're likely to be a victim of. So don't jump into waters that you're not prepared, that you haven't studied for.
Yeah, I think that last part is what we refer to as paying tuition to the markets, right?
Exactly right. I'll tell you when I've stopped paying tuition.
I still pay tuition, but so I've been at this a really long time. I guess as of this year, about 10 years of active investment and trading. And I have sort of a mixed portfolio and mixed approach to markets. I'm never just like all in on one approach. Some part of that is probably like the engineer in me. I like to stand up different approaches, sort of diversify, play around with different ideas, and I'm very active in learning. But if there's one piece of advice I would give people, it's that the very first thing you should do is just open a brokerage account and invest in low cost ETFs and start with some amount of your capital there. And the thinking behind that is that, at least for me, this isn't worth doing unless you can beat the benchmark. If you can't beat what an ETF is able to produce in a year, then this probably isn't the best way to place your capital. If in a given year you have some serious wins in a trading account, and maybe you're up 20-25% in your overall account, but then you lose 15% of that, and your net return in a given year is less than what you could have made by just putting your money into a broker account and buying SPY. It just hardly seems worth it. So a nice way to sort of hedge against that complete risk of just only trading and doing nothing else is to open up in a brokerage account, buy that ETF, just buy it and hold it. Keep contributing to that account on a dollar cost average basis, and then compete against that account. And so I think there's a lot of reward that comes from that too, where you're basically saying, I have this opportunity to be long exposed to the market. I'm not going to mess with this account. I'm just going to follow the traditional approach. And now my objective is to compete against myself. Every month I'm looking at the returns that show up. Are my equity returns better, or is my equity curve better in my trading account than my investment account? And that's sort of a nice way to reduce some of that risk, but also learn in the beginning too. I think, it's really easy to get wrapped up in the allure of making a lot of money trading. And so I think what happens a lot is people will open up brokerage accounts and then just stuff it with a whole bunch of money that they can't afford to lose, $5,000-$10,000. And very quickly they're experiencing 30, 40, 50% drawdowns on that capital. And that's really sad to see, when you could have put half of that in and, protected yourself a little bit from the initial losses you might experience, and not quite think about it from a benchmark perspective, right? Like, what am I trying to achieve here? Is it just to have a couple of winning days, so that I can show my friends that I made 12% in a day? Or is the real long-term objective to actually beat what's possible by doing nothing at all, which is, obviously the passive approach?
Yeah, it reminds me so much of I do stand-up comedy, or I used to do a lot more of it, and there's nothing like you get on stage, you take the risk of the whatever joke you want to do, and you're looking for feedback from the audience. That feedback that you're getting, and you build that up over time, and that's what makes you a funny comedian. If you get up there and you might have one good set, and you think to yourself, "Oh yeah, I'm the next George Carlin," and then you go to another set and you bomb. Right, and so the market is very much like that. The it's giving you this back and forth. Your performance is giving you there's this response of how much do you actually understand, how consistent are your returns, and should you continue doing this? And the more you take that information in and use that as the game, and like you said, if you have this long portfolio that you are then matching yourself against, well, then you can't lie to yourself, right? You can't pretend that you're doing better than you are, even if you had one trade that did 200%. Yeah, well, you had 10 other trades that lost money. So, you know, be clear-headed and don't fool yourself. So that's great advice, Mike. I like that.
Yeah, maybe the other thing that maybe took me a long time to understand as well is, because markets are completely random, not completely random, but like the returns are not, the risk, and let me rephrase this, the actual prices that show up on charts every day, they're not predictable in the sense that like human behavior is predictable. Prices will move all kinds of different directions at any given time. And so I think this is one of those domains where you can easily trick yourself into believing that skill comes with time. And if I spend enough time trading, that I'll just get better and better at it. But it's not like playing, baseball or basketball, where a consistent free throw will lead to, better shots over time. And I could just get better and better with practice. You can spend 10,000 hours trading the market and still lose money and still have a strategy that won't work for very long. It is not a guaranteed opportunity for you to spend more time doing it. And so I think the funny thing about that is, on one hand, the more time you spend doing this, the more you realize how random it is, and that and how difficult it is to extract profit from the markets. But that once you manage that risk well, once you manage that randomness well, suddenly you do have an approach that, feels like you've gained this skill. And the reason I say that, like, it's not a skill-based thing is because at any moment we could be on the wrong side of the market, and if we're not managing risk well, every ounce of skill that we've put together to get us to where we are today could be lost in a single day, right? Like, I'm sure you've been there, Tom. I've had periods where I've been a year and a half into positive performance, and I've knocked out 6 months of that performance in one day.
That's right.
It just happens. So I think it's fair to say that, like, in many ways, this is a skill-based game, but randomness is still going to play a role.
That's perfect. Very well said. Before we leave off, we do have a question in the comments here from TJ about prop firms.
Yeah.
I'm not sure the answer myself, but I will ask it to you just in case, if you know this is floating around the TradersPost community.
Mhm.
Are there any traders who use prop firms at the moment who are using TradersPost in conjunction with that?
Yeah, at the moment, any prop firm that Tradovate supports, we don't have like a list of active prop firms that they do, but if you can, do some searches on your own or within those groups, there, as long as it's actively supported on Tradovate, you should be able to use it through TradersPost. We just launched our Tradovate support a few weeks back, so this is a relatively fresh approach for us, but we'll keep an eye on that. That part of the industry, and maybe even do some content on how this can be done. We've heard Apex talked about on our Discord a few times, but otherwise, that's as far as I know. The Tradovate side is where we can support it.
Fair enough. I'm going to be dipping my toes in the prop firm pool. I really want to see what that's all about. My clients keep
Sure.
asking about it, so let me go and fail there and see what that's like. It's one of
Well,
those places where there is no practice, right? You got to go ahead and just try the prop firm challenge, and there's part of me that thinks it feels scammy, but then the whole market feels scammy. So I don't know. Bitcoin feels scammy, and it helped pay for my car. So I'll take money where I can get it. Um,
it's funny. The prop firm approach is probably a good way to to recognize the risk management aspect of a good strategy, because many of the prop firms have rules that you have to follow in order to even get awarded any amount of capital that's meaningful. So like like when I spoke to Matt DeLong on our last trading bot sessions, Matt listed out the rules for the prop firm that he's working through on CDS contracts. And I think if I remember correctly, there was a minimum amount you had to pay, but you couldn't have more than a 10% drawdown in the strategy over a period of time. And I can't remember the exact length of time that was required, but that 10% drawdown rule is a really big one. That's an aspect of risk management that should show up in your trading strategy. I can tell you right now that my strategies for the last couple of years would have failed that, but I'm still up. But I'm happy with that risk. I'm comfortable with a little bit larger of a drawdown because my returns are a lot higher. So I think for starting out beginner traders, or even people who are intermediate, that's a pretty good rubric to measure yourself by, because it can be pretty challenging to avoid 10% drawdowns at times, even if you're just long exposed. We've seen that show up in the SPY or NASDAQ.
That's right. I really like the like you said, those restrictions. If you're going to start off like, not that I'm endorsing prop firms, but you are limited in your loss, right? It's the cost that you're paying for that challenge, and you either succeed or fail. And I would have rather have learned that on a $300 charge than to learn it on a multi-figure account. So maybe it's not a bad idea for beginner traders at least to look at the challenges to see if there's something that they might want to try.
Certainly,
I'm
yeah,
really
certainly try it on paper first. Do a paper
yeah,
account, see how that plays out. Mhm.
absolutely. All right, so we'll leave it there, folks. Look, I think the both of us, we could always talk about markets like constantly all day, every day. But we have lives to live, and you guys have trades to trade. So we'll leave you there for now. As always, if you have any questions for the future, leave them in the comments. Leave them, send them to support. We'll be happy to cover them. We want to make TradersPost the best automated trading platform for you and your needs, and we're going to do that every day, one trade at a time. So thank you very much, Mike, and I'll see you next week.
See you guys. Thanks, Tom.